Good evening. Tonight, Treasurer Jim Chalmers has delivered what he calls the most ambitious tax reform package in more than 25 years. And he's not exaggerating. 3 pillars of the Australian tax system have all been rewritten in a single budget. Capital gains tax, negative gearing, and discretionary trusts. These are changes that will reshape investment behaviour for a generation. My job tonight is to walk you through the detail, clearly, calmly, and with precision, so you know exactly what has changed. Let's begin. The biggest structural change is the end of the 50% CGT discount for individuals, trusts, and partnerships. This rule has been in place since 1999. From 1st July 2027, the discount is replaced with cost-based indexation. Under the new system, only the inflation-adjusted portion of a capital gain is taxed. The effective tax rate becomes 30% on real gains. This aligns the tax burden with the average worker's marginal rate and applies to individuals, trusts, and partnerships. Grandfathering is extremely important. The government has confirmed the 50% CGT discount continues for pre-2027 gains. Assets purchased before that date will use a hybrid model. Gains up to June 2027 are taxed under the old 50% discount. Gains after 1st July 2027 are taxed under the new indexation model. This is consistent with models reported across major outlets. This matters. It will increase tax payable on long-held assets and reduce the after-tax return on property and shares. It will affect rebalancing decisions for investors with large unrealized gains and potentially cool speculative investment demand. Negative gearing has been politically untouchable for decades. Tonight, that era ends. From 1st July 2027, changes take effect. From 1st July 2027, negative gearing is limited to new builds only. Losses on established properties will no longer be deductible. Losses on established properties can only be offset against rental income or capital gains from residential property. The government has drawn a clear line. Any property held at 7:30 p.m. AEST on 12th May 2026 is fully grandfathered. Existing investors keep the current negative gearing rules for the life of the asset. This is critical for current owners. If you already own an investment property before the budget timestamp, nothing changes for you. This is a structural shift. The shift is designed to redirect investor demand toward new housing supply and reduce competition for established homes. It aims to improve affordability for first home buyers and reduce the tax advantage of leveraged property investment. Treasurer Chalmers openly acknowledged the government has come to a different view compared to earlier commitments. The third major pillar of tonight's tax reform is the introduction of a minimum tax on discretionary and family trusts. For decades, discretionary trusts have been used to stream income to beneficiaries on lower marginal tax rates. The government argues this has created inequity and complexity. The new rule changes that from 1st July 2026. From 1st July 2026, a 30% minimum tax applies to all distributions from discretionary trusts to adult beneficiaries. This means if a beneficiary's marginal tax rate is below 30%, they will still pay 30%, no exceptions for lower rates. If their marginal rate is above 30%, they pay the higher rate. This applies to business and investment income and capital gains. The government confirmed exemptions for testamentary, special disability, and charitable trusts. These remain under current rules. Also exempt are fixed or unit trusts and certain farm succession trusts meeting specific criteria. This detail matters. Trust distributions made before 30 June 2026 remain under current rules. Undistributed income is not retrospectively taxed. The minimum tax applies only to distributions made on or after 1st July 2026. This is a clean change with no retrospective clawback. This will materially affect SME owners, professionals, and property investors using trust structures for intergenerational wealth planning. For many, the effective tax rate on trust income will rise significantly. Now, let's look at SME and business implications. Small and medium-sized businesses are disproportionately reliant on discretionary trusts. Tonight's changes will force many to reconsider. The 30% minimum tax makes company structures more attractive. CGT changes also reduce the benefit of holding assets in trusts. Negative gearing restrictions also reduce the appeal of trust-owned property portfolios, but there is some targeted relief. From 1 July 2026, SMEs can transfer assets from a trust into a company without triggering capital gains tax. This applies provided economic ownership remains the same and the company is an active Australian resident. It softens the transition. This is designed to help the more than 900,000 SMEs currently using trust structures across the country. These reforms are not small adjustments, they are structural changes designed to shift investor behaviour in Australia. In property markets, we expect reduced demand for established homes and increased demand for new builds, easing pressure for first home buyers. Investors will likely face lower after-tax returns and rebalance more frequently. We expect greater interest in superannuation. SMEs will likely migrate from trusts to companies, focusing more on dividend strategies rather than trust distributions. The government expects these measures to raise tens of billions over the decade, with the majority coming from CGT changes. Let's summarise the three major changes and the grandfathering rules all in one place for your reference. First, capital gains tax. The 50% discount is abolished from July 2027, replaced with indexation and a 30% minimum tax. Pre-2027 gains still get the 50% discount, and a hybrid model applies to existing assets held through the transition. Second, negative gearing. Restricted to new builds only from July 2027. Established property losses only offset property-related income. Any property owned at 7:30 p.m. on 12th of May 2026 keeps full negative gearing for life. This is the key protection. Third, discretionary trusts. A 30% minimum tax on adult beneficiary distributions starts from 1st July 2026, with key exemptions. Distributions before 30th June 2026 remain under current rules, with no retrospective tax on any accumulated income. These reforms will reshape investment and business structuring across Australia. They are complex and far-reaching. Now is the time to understand how these changes affect you and what decisions you need to make before the deadlines. I'm Michael, and this has been MetaCoop's detailed analysis of the 2026 federal budget tax reforms. Thank you for watching.